All right, what's up, everybody? We're here for episode 2 of the What's the Deal podcast. We're going to be talking about 2022. I'm going to kick it over to my main man, Chance, so he can start the conversation off.
Hey, good to be here. Good to have everyone here. We are going to be talking about 2022 and some of the historic events that occurred within the real estate market and things that we saw from different fields within real estate. We got Forrest Knott here with us tonight. He is a lending broker. He's been working with us for years. Great guy, a good friend of mine. Going to let him introduce himself, give a little bit of his background, and then we're just going to start having a conversation about this roller coaster year that occurred in 2022. Forrest?
Thanks for the introduction, and thanks for having me on, Chance. Yeah, so I'm a mortgage broker. I'm just over 25 years in the mortgage banking industry. Kind of done it all from a lot of the big lenders to some of the smaller shops. I'm now doing virtually everything. Conventional loans, government loans, non-QM loans, DSCR loans, hard money loans, bridge loans, commercial, SBA. So yeah, been around for a while, and yeah, happy to be here.
Absolutely. So what do you think is the bulk of your business right now?
Bulk of my business right now is a combination of DSCR loans, hard money, and first-time home buyers, which really right now there's a big push with FHA. Back 2020 and 2021 and 2022, the purchases that were happening, we were seeing a lot of the stronger qualified buyers, I'd say, doing conventional loans, 20% down or over 20% down. I haven't been seeing as many of those in the last 6 months, but what I have been seeing, which is really interesting, is more first-time home buyers coming in, on FHA loans with 3.5% down, or down payment assistance or grants. Part of that is because, quite frankly, the market's allowing it now. Previously, those offers were never accepted. I have one client I have been working with. I think he's kind of slowed down his search now, but been working with. I did his pre-approval a year and a half ago. He was looking to buy do 2 to 4 unit property using an FHA loan, which is a brilliant strategy. Brilliant. To buy something like that, still only do 3.5% down. And he had the money to do more, but he was just sticking to his guns. That's what he wanted to do. It makes sense. But just could not get a offer accepted because it was FHA small down payment. The problem with sellers and realtors is they look at that as somebody who is underqualified, and the guy putting down more money is more likely to close on time. And the truth is, if you're pre-approved, you're pre-approved. That might not be the case everywhere, but with me, if I give someone a pre-approval, it's rock solid. I know I'm going to take them to the finish line and do it, in under 30 days, if not under 20. I get it. A lot of people don't have had different experiences, but it's there's nothing wrong with an FHA borrower. I'm actually using that on my own transaction. Even though I could put 20% down on a conventional loan, I'm doing that because it just makes sense.
Yeah, why wouldn't you?
Yeah. And so the difference is, in the couple years prior, those offers were just getting rejected. They were never getting accepted because everyone had multiple offers on each listing, and they had a variety of conventional 20% down buyers to choose from, which doesn't even mean that those could be pardon the French, but those could be the pain in the ass borrowers, to tell you the truth. Those are the
Mm-hmm.
guys that are probably going to be, they've got a little more, whatever it is, money to throw around. They're going to be a little more demanding versus the FHA
And that is
borrower.
so true.
Yeah, the
Yeah.
first time home buyer with they're grateful to get into the property, grateful. And
Mm.
so problem I'd argue you might have an easier transaction with that FHA borrower. And
Yeah.
so yeah,
And too,
it's
go
now
ahead.
they are allowing now homes are not selling with 30 offers day one. Now they are, 2, 3, 4 weeks listed with no offers or lowball offers or something like that. So now the FHA buyer that comes in is much more appealing. That meaning they'll take anything. And hopefully people start learning that that's not underqualified borrower. They
Mhm.
are, at the end of the day, the seller's going to get their money. You're going to close. Who cares if the money comes from FHA, VA, Fannie, Freddie, USDA? Who cares? It's all money. But
Yeah, absolutely. And a flip side of that, from a different perspective, having, sold quite a bit of houses through our business, this is probably not the mentality of a lot of people. I think that the general public and the general homeowner that's selling their house probably views it exactly like you described. They think, oh, this is an underqualified a buyer. From our perspective with selling real estate, as a business, one thing that we look at is if it is not the borrower, but it's the program. So with FHA, we generally will take a conventional offer over an FHA or a USDA solely because of the stringent like inspection requirements. Sometimes companies like an FHA or a USDA, at least in this area, I don't know, if it's different by area or not, but that's sometimes something that we consider. But obviously, we take the offer as a whole, and I think a majority of the population, like you said, has a misunderstanding of the program. The buyer is no less qualified by any means under an FHA versus a conventional. The only thing that we look at is some of the stringent requirements of their inspections, which usually aren't that bad,
you're
but there are
you're
a little more.
right. Yeah, it's absolutely true. And there's something to be said about that. But that's going to be more in, something with an association. You can run into problems there, or unpermitted stuff
Yeah,
also, or if there is some defects or deferred maintenance on the property, that type of stuff. But for like a cookie cutter, for lack of a better term, clean, sort of deal and property where everything is original, permitted and all that, really no problem. But you're right on more of a challenging property. By all means, conventional is going to be way
hmm.
smoother.
And let me ask you this. This is something that I actually just recently learned. It's maybe not an issue that normally would affect uh, a normal a normal seller or buyer or a normal uh, flipping company or someone that does investment in real estate. But here at Casey Capital, we like to do things pretty fast. We like to do things quickly. We like to get in and out. And so a new thing that I learned about not too long ago is that there is actually a 90-day seasoning requirement for FHA for flip properties. So you can't
Oh,
purchase a flip property, the day that you go under contract on a flip property has to be 90 days from the date that the current owner purchased it. And
oh, wow.
yeah, no, I had no idea. Nobody had any idea. The house that we just closed on last week, the lady, went under contract on it, and we were under contract for like 4 or 5 days. And she came back. She's like, "Hey, do you think you can contribute, some money to closing costs? Because turns out I'm gonna have to bring 20% down to make this transaction go through." I'm like, "Well, why?" And she's like, well, because of this. And we looked into it. And I'm like, oh, wow. She's right. Yeah, we'll give you $2,500 for closing to get this thing done. We're not going to be able to sell it in 90 days as an FHA buyer anyways. I think it had been like 45 days that we had the property
Oh.
and turned it around. But it's a unique problem. I guess it's a good problem to have because that means you did it very quickly. But yeah, so FHA has a seasoning requirement for flip properties.
Never knew that. That's great to know.
Mm-hmm. I didn't either till like 3 weeks ago. But yeah, it's crazy that they have
One
them.
thing I want to share, just because it's such, it's all over the news right now. If you haven't seen, in respect to FHA, for future clients, it is going to get a little bit easier for them to qualify, particularly with rates going up. For example, I just did a pre-approval Monday. Did a pre-approval Monday for some clients here in Hawaii up to 490,000. And they have just asked for, to check in and said, hey, can you give me an updated pre-approval letter? Needed a couple changes. And I went to do it, and we took them right to the threshold of the debt to income ratio. And I had to call the agent. I said, they don't qualify anymore. That was Monday.
Wow.
Rates went up. Rates went up about 0.3%. And I said,
Wow.
they either have to buy down the rate, or they're going to have to bring in more money. There's, a number of things we could do. I said, but if we can just wait till next week, and I was like, I'm okay sending an updated pre-approval letter, but we can't lock, or really even, we can't request an FHA case number until next week, because FHA just lowered mortgage insurance premium, the monthly mortgage insurance premium, from 0.85 to 0.55. So 30 basis
Okay.
points lower. So to
Is
put
that
it in,
that to try and help the rising
yeah.
interest rates? Okay.
Well, I don't know, just help
In general.
buyers. I don't know if it's necessarily just in respect to the rising rate. It'll stay that way, but it's so.
Speak to mortgage insurance real quick. What entails that? That's because of the low down payment, right?
Well, for FHA, it doesn't matter if you put 50% down, you're going to have mortgage insurance on FHA.
Really?
Now, it changes based on how much you put down. If you put 3.5 or 5% down, you're going to have as of today, the 0.85%. So the easiest way to look at this, to put it in layman's terms, in my opinion, is let's just say the interest rate on the loan is 5%. And then you've got your mortgage insurance, which is 0.85. Your effective interest rate is 5.85. It's going to look exactly the same if you take a 5.85% rate with no mortgage insurance, or a 5% rate with mortgage insurance. It's just like adding 0.85 to the rate.
Okay.
So now they're dropping it 30 basis points, 0.3 to 0.55. Now that's if you put less than 10% down. If you put 10% or more down on an FHA loan, two things happen. You get the slightly lower mortgage insurance, which as of today is 0.8 instead of 0.85. And going forward, it'll be 0.5 instead of 0.55. Also, it will fall off automatically at 11 years. If
Okay.
that's if you put 10% down. If you put, anything less than 10% down, you'll have that FHA mortgage insurance for the life of the loan, even if you do streamline refinances and all that type of stuff. So there's that. So that's the difference between, the two options of, why some might have a little bit higher mortgage insurance than others. It's based on the down payment. But in any event, we are going to, I think it's Tuesday, it goes into effect. We're going to recover that. We lost, about, close to 40 basis points this week in actual mortgage rates, but we're going to get 30 basis points back on the mortgage insurance next week. So we're going to so that person who I qualified on Monday, who doesn't qualify on Friday, Tuesday, they're going to qualify again if rates stay the same, because the mortgage insurance is coming down.
Wow. Yeah, it's amazing how just small shifts, there's so many variables that comes into qualifying for any type of loan, right? Like it's not just credit and income. I mean, there's so many things that change that, and ultimately that is the two biggest things, but there's so many factors that are affecting that, such as the mortgage interest, the rates, the insurance rates and all that, and being able to and from our own experience working together, being able to understand those things and know how to tweak them as needed, and what to do to get someone to a point where they can qualify for that loan. That just speaks to your expertise. I mean, there are a lot of people, a lot of lenders, a lot of brokers, I've dealt with plenty of them. They wouldn't even think ahead like that. Like, hey, the insurance rates are about to drop, and that's going to make him qualify on his debt to income. So yeah, definitely kudos, man. That's some forward thinking, and I already know that about you for sure, because I mean that's we've been working together a while, and that's one of the great things about you. So
Thank you.
That's pretty cool.
One more thing while we're on this topic of credit and income.
Yeah.
Because you and I have done this together. I know I've done it personally. I know you've done it personally. I think you and Sadie may have also. I forget exactly, but or vice versa. But I just dealt with this with another investor I just started working with. I met last week, who needs to improve her credit, and she's going to JV on her first deal. And I suggested she do what we've talked about, which is, and I'm sharing this with you to maybe share with your potential buyers, because if they can do this like right at the first conversation, like literally before they get to me, we can, work something out where, where if we got a couple weeks, if we can take those people with maybe lower credit scores, and get them to be added as an authorized user to somebody else, friend or family, that has an account, a long-standing account in good standings with low credit utilization. We can add them. We can see a quick jump. I'm trying to remember to tell that to people, everybody I talk to who is trying to get prepared to get financing in the future. Maybe they're not like going into escrow today. They want to do pre-approval and start looking and say, hey, if you're not already a 740, go find somebody that will allow you to do this. And that it just makes a world of difference.
We'll leave names out of this part since it's public, but I think the last person that we did that with, I think their score jumped up 70 points, like 70 points in a matter of like a week, from adding them to one to as an authorized user to one of the cards. And the thing is too, if you got someone, if someone doesn't want to add you to a card and give you, they ain't even got to give you the card. Just let them add you as a user. They can cut the card up and throw it away.
Well,
yeah,
they don't even need to. I think when you can add somebody, you don't even need to. You can request that I don't want a card issued, and they don't need the account number or anything.
Yeah, that's huge. I mean, especially I think where it helps people a lot is when you have like the kind of like what they call a thin file. Especially if you don't have a lot of negatives, but you just got like that real thin file. Throwing in something that has 3, 4, 5 years of payment history on time, with almost no utilization. I mean, that just skyrockets it. So and you've seen it, I've seen it. It's a great tool. It's a great tool.
I'm actually going to make a video on that. It's I've been kind of down on I do my videos in batches, and I'm going to make one specifically on that because it's so useful.
Yeah, and it takes nothing, right? Like it's not like someone's doing that is so much smarter and better than co-signing on a loan for somebody, right? I mean, like, let me add you as an authorized user to my card, not even give you a card, let it jump your score up and do it yourself, that way. That's so much better than signing, co-signing as a guarantor on a loan or something. It's, that's so much smarter. Yeah, that's great. That's a great comment there, because it's crazy, in doing this and being in this industry, doing this business, there's a lot of things that I think that we take for granted as common knowledge, and I think that's why within social media and these things that we put out, content that's put out, is so helpful to people. People are like, wow, I never would have thought of that. Some of this stuff that we see or experience, we kind of consider it common knowledge. And definitely, being able to spread that out and help people is definitely part of what we want to do and continue to do. I know Nick and Jason both teach financial literacy courses, and that's something at Casey Capital that we're looking to do this year is actually to provide those courses to our tenants, all of our
Oh,
tenants, free of charge.
that's
So,
amazing.
um,
Wow,
yep,
nobody's doing
yep.
anything like that.
Yep, that's exactly what we're looking to do. And we're working with some programs. You and I have spoken about the rent to own stuff that we're doing and positioning people to be able to buy their property in their house. Putting them in kind of a funnel. Getting them the property, letting them move into where they need to move in, want to move in, and then putting them in that funnel of developing payment history, working with you as their lender, and working with the different credit repair people that we have, and getting this advice, to be able to position themselves to buy these properties. So we have some people that we're associating with. I believe some people that are going to be investing in some of our funds that have some programs that are key people in those programs. So some great partnerships coming up, great things going out to our tenants. And the thing is that not everybody's going to take advantage of it. But there's the people that are, they're going to take it and run with it, and it's going to really make a difference. So there's power in numbers, and being able to broadcast that information across the network of people within our business, all the way from key level partners, investors, all the way down to contractors and our tenants. Being able to spread that out is going to be a big thing for sure.
That's brilliant. Yeah, it's so funny you say that because there's so many people that probably believe buying a home is hopeless, and
Yeah.
they just say, "Oh, I can never buy a home." Well, they don't realize that, hey, you can get a home, you can get an FHA loan with a 580 credit score. You can even get with a 500 credit score. But with a 580
Mhm.
credit score, not only can you get the loan with only 3.5% down, I've got an investor that will do a 3.5% down grant. It's not a second on title. There's no repayment. There's no restrictions like some of the other down payment assistance where they have to, um, you know, they're prevented from selling or refinancing the home, for a certain number of years before it's forgiven. This is a true grant. Now the start rate is higher. It's 7.75 as opposed to, high fives. But um, with that and with a seller credit, I can take virtually anyone with a 580 credit score that hasn't had bankruptcy or foreclosure in the last couple of years. I can take just about anybody. They do need their income to qualify, I guess. But we can qualify somebody to get into a home without one dime out of their pocket, not a
Wow.
dime.
Yeah, and
Um,
let's talk to about and man, we'll get into the topic of this podcast in a minute, but this is good stuff. Talk to about so those are like the obvious like traditional issues that we run into that a lot of people run into, but some of the first dealings you and I had together, I was in a unique situation when I tried to buy my first home to live in, and that was because I was a business owner. And so there's a lot of business owners that don't know the right direction to go in order to purchase a home. So speak to that a little bit too, because that's kind of there's a lot of content I've seen. Certainly nothing like you can provide with some of the programs you're speaking of, but that speak to, hey, how to get in a house with no money sometimes, how to get in a house with a lower credit score. But no one tells the guy over here running a company, hey, how do you get in a house without all the without getting slammed with taxes and all this other things, like
yeah,
you
yeah.
got to write off stuff for your business, and then you don't qualify because of your income. So how what's some options that they have?
Yeah, so great question. So kind of like we did for yourself years ago, there's, bank statement loans. You can do 24-month bank statement loan. You're going to get the best pricing, but you could do 12-month, you could do 6 and 3 months even.
Oh wow,
Um,
3 months now.
3 months. So
Wow.
um, let's just say hypothetically speaking, you have your business. You do have to be in business for 2 years. We got to be able to prove that.
Hmm.
But let's say the first year and a half sucked.
Yeah,
And
do it
you
after a good quarter.
yeah. And then you've got a job that pays you, really well for 90 days. Give me those
Mm,
3 months bank statements and boom, you're qualified.
wow.
There's
Wow.
also a 1099 only. I could do 1 year 1099. They vary.
Mm,
These also require larger down payments, but
right.
it's geared towards a
Yes, they
person
do.
who, has the income. They, hopefully have the down payment reserves. It's just they write off, they're self-employed, they write everything off on their taxes. So as long as that person come in, sometimes it's, they all vary. These different programs I'm going to speak of, 15, 20, 25% down. There's a P&L only program where if we can get
Wow.
a profit and loss statement, has to come from a CPA. Um, you know, then it's that's it. A
Hmm.
licensed CPA puts together a P&L for your business. Now remember, there's two P&Ls. There's P&L when you file your taxes, and then there's a real one.
Yeah, yeah, exactly.
So,
Yeah, I was kind
I'll
of reading your mind on some of those chuckles there. I was like, yeah, I know what he's thinking.
kind of, that's leave it at that. Um, you don't turn in the P&L that you do for your taxes. You
Yeah,
turn in the legitimate
yeah.
P&L, and you're good.
Mm,
So we've got, the 1099 program, the P&L only program, the bank statement programs. Um, there is now it's called the My Community program. We have a program where if you could put 25% down, um, and the rate's not even terrible. I haven't priced one for a while, but it's not too far off conventional loan rates. Um,
wow.
25% down, and it's straight up stated income per primary residence.
Wow.
Catch is, depending on your credit score, you're going to need 12 to 24 months reserves. So you need
Mm,
25% down and 1 to 2 years reserves. But that can come in the form of IRA, 401k, stocks.
mm,
You can use other investments as your reserves. So once again, this is for the person who has a hard time proving the income, but they've got income, they just can't prove it. But they got a
mm,
decent amount of money in the bank. It's a stated income loan. And
mm.
I've been in the business 25 years. When the market crashed in 2007, we thought we would never see that again. Well, it's been around for a couple years now.
Yeah, I was about to say that definitely wasn't around when I was there.
Yeah.
That's cool though, man.
I
That's
mean,
definitely like the
there's truly something for everybody.
yeah,
It's
yeah,
yeah.
no, that's cool. And and maybe I think we could definitely have some good going forward as we continue to do things like this. I think bringing you in on some of this financial literacy stuff, I think is going to be really great if that's something you'd be interested in.
Yeah, I'd
I
love to.
yeah, I think it's going to be positive for business in general, but I think we'll really be able to reach out and touch some people and really help them in that journey. So for sure. So segueing into our topic, what was the deal with 2022? Tell us kind of 2022 through your eyes and some of what you saw and obviously towards the end, we'll kind of talk about what you saw from KC Capital during that time and how that looked. But just in general, what did 2022 look like and through your eyes?
So we got a lot of threats throughout 2021 that the feds were going to stop their bond buying program, which was really helping suppress the interest rates.
Mm,
Um, I forget the exact number. I think it was the feds were averaging buying, I believe it was roughly 85 billion in mortgage-backed securities through 2020, through COVID, the start of COVID in 2021. And then each Fed meeting, they said, oh, we're going to have to taper this off and we're going to stop doing this. And naturally, it's going to raise rates. And they kept saying that through all of 2021. And then in November, or maybe it's September, they said, November, it starts. And um, they were going to taper, I believe, until March of 2022, where they would be done. The Feds would no longer be buying mortgage-backed securities in the secondary market, and that would was going to have an impact on rates. So they were going to do it incrementally over those months. So November was the first sign of rates coming up. And then, December kind of stayed a little bit the same. And then I think they announced they were going to accelerate that. I take it back. I think it was originally supposed to, drag on until April or May. And then I think it was in January, they said, we are going to now conclude this by March. And that's when all hell broke loose and rates just started jacking up in January. We still saw some rates. I don't think I recall doing anything under 3%, but we're still like right at 3% in January. Conventional 30-year fixed.
Right.
And then by, gosh, I forget the exact dates, but it just, by March it was getting ugly. I mean, if I recall correctly, I think we might have already been around 4.5% by then, 4 or 4.5%, somewhere in there. That was what happened. We skipped over like a full 1%, and it just got it went from like 3.5 to 4.5, like in 30 days, and they concluded the bond buying program, and then we saw, with that's basically the bond buying program stopped, and I think it was right around March was the first rate hike, and then we had the rate hikes, and as I'm sure a 3/4 point rate hike or a 1/4 point rate hike by the Feds, that adjusts the federal fund rate. The only thing that really directly impacts is a home equity line of credit. So if Feds raise rates 3/4 of a point, if you have a HELOC, your next statement is going to be 3/4 of a point higher. If you have a 30-year fixed, or excuse me, if you're shopping for a 30-year fixed, I should say, that doesn't mean the day after that your rate that is going to be offered is going to be 3/4 of a point higher, but it does have a trickle-down effect because the cost of money for the banks just got higher, so now they got to increase their margins to accommodate for that. So that started this rapid rise, and as we talked about earlier, the fastest. 2022, we didn't reach the highest rates in history, but we surpassed the fastest rate increase in all of documented history.
Wow.
And
that's impressive.
Brutal. Yeah.
I mean, and so to clarify, you were saying that when you have a HELOC, right? So your next monthly statement is going to adjust based off that Fed rate.
Mm-hmm.
So the HELOC is like an ARM mortgage from hell, basically.
Yeah.
Like that is, man, that is rough, for sure.
Yeah. I mean, I've got a close friend that pulled out $250,000 on a HELOC to do a massive renovation, down to the studs, gut job on his home in Southern California. Did this fall of 21. And he just fully leveraged that thing in November of 2022. And I forget where it started, where it ended, but it's brutal. He was watching his cost of money go up by 3/4 of a point with every Fed meeting last year.
Oh, yeah, that's rough. Yeah, and that's the thing is, when you make plans in these markets and throughout, to do real estate deals and things like that, there's a lot of unforeseen stuff that happens. COVID, my God, right? Like that was crazy. I mean, everybody just shut down. Banks shut their doors. They're back now. I mean, there's plenty of, you and I have had a conversation about plenty of banks that were great banks that they, some of them quit doing retail lending, went to broker only and really just kind of closed up and tightened up, and a lot of the programs that were there disappeared. And I mean, that was very uncertain as well, and then for that to be followed by this wave of just, I mean, I've said it tons of times through conversations and webinars and stuff. But 2021, any asshole with a hammer and a paintbrush could go out and make some money on a flip. And it was just this wave of I guess no credibility, no, not being held accountable for anything. Not being held accountable for making a bad investment decision buying a house, because if you bought a house, it wasn't a bad investment decision. There was no thinking to do. If you could buy a house and put some paint on it, you were going to be able to sell it for some money. And that I think that following COVID and then the 2022 hitting like it did, I think it told on a lot of people. And that's one of the things that I definitely saw, us coming from a background of kind of being those boots on the ground. We went from doing construction to doing construction for real estate investors, one-off people, and then we went to do construction for some institutional investors. And we were dealing with companies that had 6, 7, 8,000 up to 20,000 house portfolios, that we were doing the work for them. We were doing the management. We were doing these things. And our companies quit doing any dealings with them early on in 2022, and focused full time on growing our portfolio and our investments and doing what we did last year. But one of the things that we tried heavily to tell them before we stopped managing their stuff was like, listen, you can't keep making these decisions. You can't keep buying willy-nilly. It's not 2021, it's not 2020. You can't keep doing things this way. You can't go buy a house for market value, put 20 or 30,000 in it and be okay. Eventually that's going to catch up to you. And that's one thing that as at Casey Capital, we're expanding, continue to expand. And one thing that we took away, our leadership took away from that experience, was that the rapid expansion of large real estate funds and companies in 2020 and 2021, I don't think they hired bad people. I think they hired on a substandard of what the standards they taught were. Hey, yeah, just buy the house, get the numbers, get us 15 houses a month in this market, and not, I would rather have 10 quality houses than 20 mediocre ones. So they were just having the standard of hit these numbers, hit 15, hit 17, hit 20 in markets that's not sustainable, not because the houses aren't there, but because you have competition, you have these other things, and to find that many quality deals is not there. So they taught all these people, hey, just do this. And they were doing it, and they were fine in 2020. They were fine in 2021. And then coming into 2022, when they started keeping the same, you can't unteach something. So all these people that they onboarded and brought on, they had the standard in their head, and they just kept it going, and it went unchecked all the way through 2022. And now a lot of those companies have shut their doors, in the sense that they aren't buying right now. They're completely shut down. They're not doing anything. Their crews are laid off, and they've stopped buying. And I think it's because from improper standards. The standards that you set for your buy box and for your investments need to be regardless of market. You need to set it based off percentages, not off of number of houses you can buy, but what number of houses fit in this percentage of a buy box. So whether the market's up or down, I need to buy this house for X amount percent of what it's worth. If it's in a market where it's worth 180, I need to buy it for whatever percent of that. If it's in a market where it's worth 225, I need to buy it for whatever percent of 225 the buy box is. So I think it told on a lot of people. So did you see an increase of I guess investor slowdown? I know you said a lot of what you do right now, and maybe touch on DSCR too. I know you say a lot of what you do is DSCR and hard money bridge loans. So in 2022, what happened there with some investors, and maybe more towards the end of 2022? Because I think a lot of people weathered it out relatively well throughout the beginning, mid, third quarter. I think people started really feeling the effects towards the end of that year. So what did you see?
I saw the opposite of what you would expect.
Really?
Now with yourself and Casey Capital, I was concerned by the time we really started getting rolling. Things were getting ugly and the rates were going up, and I was concerned about the rates, cutting in your margins where it just wasn't going to make sense, and how is that going to impact, your portfolio of investments and all that. And you guys, weathered it beautifully. You just kept doubling down, obviously making the right decisions on the properties, but doubling down. And I've told you this before, you definitely deserve a pat on the back. I mean, whenever I talk to my account executives at different lenders and it explain, because I mean, there's a story behind what you're doing, so I tell them the whole story as we're discussing, if they can help. And I have to always repeat myself when I tell them the number of the and I said, you've been a contractor, you've been doing flips for a long time, but you really started buying your own properties to buy and hold, in first quarter of 2022. And then when I tell them the number, they're like, wait, what? And they're like, they have a hard time believing it, and not, or they think I misspoke. So that's been fantastic. But I'll say 2022 through current, and even more so this first quarter. And that might partly be because I've been attending a lot of investor meetups and stuff and doing some networking here in Hawaii. But there are, like I said, first-time home buyers, are out there, but it's predominantly investors. Like, as the, first-time home buyers or just buyers in general are pulling back, I see more investors doubling down and trying to take advantage of this down market to get the deals on discount, to not have to get into a bidding war, to just kind of, find the pain and kind of, take those properties. But it's been the investors are out in force. They have been not much like yourself. I mean, some of them don't pencil out. I've done some quotes for some investors on DSCR where, and this is more last fall when it really got bad. The DSCR rates have come down again, but I've done some for them where they're like, I'd love to do it. It just doesn't, the numbers don't work. But since rates have come down on those DSCR programs, I've been flooded with them. I'm quoting several a day, and they're a lot of people are taking advantage of them, and they're going a lot. And these are more, let me say, less experienced investors, not like yourself, where not a large portfolio. These are like, they have one or two properties now, and they want to buy a property using a DSCR loan to not do a fix and flip, or even really, do any value adds, really just buy something to rent it. So a lot of people are, as opposed to yourself doing something where you do, like a hard money loan to get some renovation money out of it to do rehabs. More of the people I'm working with are just looking to buy, 2 to 4 units predominantly, and just get in and throw renters in there. But I've had more people with all the social media stuff I do. I've got my DSCR video, kind of grateful I did that, because that's I think that thing is that thing is like 340,000 views on TikTok, and I don't even know, I think it's at like 800,000 on Facebook, and I still get a couple calls a week. Hey, I saw you on TikTok, saw you on Facebook. Can you tell me more about the DSCR loan? And that's, people are coming out. And again, that might just be my experience, because that's kind of, what I've put out there. But that's what I'm seeing. It's just like, it's all investors right now.
So you're seeing
everyone
a
else
lot
is
of
kind of scared
DSCR
on the
purchases.
sidelines. Yeah.
So what so DSCR purchases, and so coming out of through 2022 and into 2023, you and I had a conversation about this earlier today, but there's like some polarized sides, right, of where the market's going. The a lot of people within our network, and from what I've seen, everybody sees this as opportunity. The opportunity that exists right now. I couldn't think of a better time to be buying real estate. And a lot of people see this as one of the best opportunities that's been in existence for a long time. So, what's your stance on where we're at and kind of going forward? How do you see this upcoming market? Is it an opportunity? Is a time to pause? What do you think?
Um, uh, the last week has really thrown a wrench into, I guess, how strongly I believe in my position. But I firmly believe what, some of the people I respect the most have been saying, that we should see, a 30-year fixed mortgage rates, below 5%, by second quarter. May is when they're calling it. Now that was as of a month ago.
Mm,
But that was been expected for, since, third or fourth quarter last year. Now, I everything pointed in the recent Fed meetings that the last Fed meeting was going to be a quarter rate hike, and this one coming in March was going to be a quarter rate hike, and then that was it. And there would be no more Feds raising the rates in 23. And naturally, like I said, how mortgage rates, are related to federal fund rates. Mortgage rates, once that kind of plateaus with the Fed fund rate, mortgage rates can come down, and they can come down rapidly, even if the Feds don't lower the federal fund rate. And that was what we expected, and that was more just expecting that, with these rate hikes, they've squashed inflation and pushed us into a recession, and that's where now they're forced to lower the rates. I've been a believer that that is the way it's going to play out. Sometime between spring and summer, we're going to be there. The pain will have set in, and we'll be in a legitimate recession, even though we've been in one for 3 quarters now.
right.
We, I think we said, I used this quote the other day. It's been more of an inconvenience for most Americans up until this
Mm,
point. But it's said that the pain is going to really start to set in, where people are going to really start struggling to pay their bills, and as well as, bigger companies are going to have to lay off, and those people get laid off, they stop spending money. Then the companies that they spent money at have to lay off. It's just a trickle down effect. um, so I firmly believe that position, that we're going to see some real rate improvement before summer. um, the data that is coming out now, there's a lot of smoke and mirrors. The jobs report that came
mm,
out in January, that's based off, um, there's I forget the term, it's a seasonal adjustment, I think they call it.
mm,
And so the jobs report came out saying, oh, the jobs are up and all this. Well, they're looking at December.
right.
Everyone staffs up for the holidays.
Mm,
So that's not a true reflection, because those are seasonal temporary workers.
right.
They're staffing up for the holidays, and then they're gone in January, but they make it look like, oh, the jobs, everything's booming and all this, and it screws everything up. And then
Mm,
so that looks like, oh, there's no recession, like the economy's booming. So that was the first screw up when that came out in January. We had a lot of our gains, that 1% that we've gained from November to January is washed away. Now, gosh, what week are we? I think it was Tuesday of last week, CPI inflation data came out, and basically, indicated that, inflation is still running rampant. And that's when they said, hey, Fed said, I know we said we're going to do a quarter rate hike in March, and then we're going to be done. Well, now they said that may be a half, maybe 3 quarters, and there is no end in sight, meaning we
mm,
could continue rate hikes at every Fed meeting through 23. Now, the Jerome Powell and the Feds, they seem to change their tune like the wind. So I don't know
Mm-hmm.
what to say. I would like to say this is just a knee-jerk reaction to some bogus data. And then as we get new data, things are going to calm down as expected. I don't have the crystal ball though, and one thing we've learned through COVID is you never know what to expect. Anything's possible with our government. So
Yeah.
I don't know. I just don't know. I certainly hope it stays the course of rates trending down, by summer. But if they keep trending up, that could cause that's really gonna make some waves in real estate because it's going to really make
Mm.
things unaffordable. Um, and we could see a change, and it's just kind of too early. This is all brand new news in like the last 10 days, and no one really, a lot of people might have opinions, but it's anyone's guess what's really going to happen in the next 60
Right.
days with rates.
And do you think that maybe some of the news that the Fed's putting out is maybe trying to curb some of that hope, maybe that came out to try and maybe curb
Thousand
some of that?
percent, a
Yeah.
1000%.
Yeah. I mean, so if you're
I
if
mean,
the whole
the
yeah.
media is trying to scare buyers, I believe.
Hmm.
Media is trying to scare people. The sky is falling. Um, I hate to say it, I'm a little cynical on some of this
Mm,
stuff, and you got to keep in mind how some of these, institutions. I mean, BlackRock and Chase, they both, said they're slated to buy like 1 billion single family homes this year. I mean, they're coming in,
yeah.
so they're
Yep.
telling, hey, you don't buy, it's risky. Don't you buy because
Yeah.
you could lose it. But hey,
Hmm.
big banks are going to buy, and
We're
you just
gonna come
stay.
by.
Yeah,
Yeah.
you just stay a renter. It's safer. You play it cool, while all
Hmm.
the investors are buying. So I don't know. I think all of that it's
Hmm.
all the media and all this stuff. It's all in bed together.
Yeah, yeah, and we won't go into some of that stuff with the media and COVID, but I actually had a conversation this morning with a friend of mine, and we were talking about how it's amazing the amount of control that the media has over the general population, and the just the willingness to follow whatever that's being put out. It's cliche, and I hate to say it. I hate the reference of people as sheep, but I mean, it really is. I mean, just whatever direction the media is wanting to herd people in, a lot of people are willing to follow pretty blindly. And then later, when it comes out that wasn't the right decision, they're like, "Oh, yeah, you're right, it wasn't the right decision." But so yeah, so I think from what you're saying, it definitely sounds like that, and the overall goal of raising the rates was to slow people down. So if you can slow people down through the threat of raised rates, that is it's same end goal, different concept, so that could very well, what it sounds like, be it as well. But so that's for the general home buyer. But like you said, for investors in this market and for investment real estate, it really doesn't change anything, right? It's more of, you just got to figure out how to make that work. You got to figure out different strategies for it to happen. And two, if it's becoming difficult for and two, remember that when dealing with investment real estate, we're looking at it like, hey, what's this going to cost them rent? And they're going to be paying the mortgage. So, and then your traditional home buyers going, hey, I'm going to have to pay for this mortgage for as long as I can, as long as I'm alive. And a lot of people don't consider the options of refinances and things like that. They don't understand, a lot of people don't know those options are there. So for investment real estate though, definitely there's still the opportunity this is the opportunity zone. There's going to be people that if the traditional home buyer slows down, then the market's almost going to be owned by investors. Is kind of what it sounds like you're saying, and what you're seeing even right now, is that the investors are kind of owning the market, and I think it's no secret that big institutions that had their hands in the government's pockets probably that's what they wanted.
Exactly.
Yeah. Yeah. So
I mean, you did
yeah.
a great job in pivoting when, say, loan to value got cut back.
Yeah.
I mean, you were very methodical about it. You just said, okay, on that one, you said, this is it. We just, it screwed us up on that one transaction, but you said we just have to adjust our buy box and
Yep.
buy according to the new guidelines and make that, find deals that work. And a lot of people aren't that savvy. They'll kick and scream and just say, oh, well, I'm done. It doesn't make sense anymore. Well, you still found a way. You just needed to, again, adjust your buy box, accordingly. And like we talked about on a phone call earlier today, it's just, pivoting and adjusting with the market. What worked in 2020 or 21, wasn't working in 22, and it's not going to work in 23. But there
Yep.
is a model that works in every market. It's just, there needs to be some adjustments. You can't be stagnant.
Right. And there's always a solution to the problem. And when you think about pivoting your buy box to that correct percentage based off the LTVs, it's not that crazy of a concept, because check this out. If everybody's cuts LTVs to 70%, 65%, 60%, guess what? That's what everybody's getting. So my offer is not, you're not going to get a better offer than mine. Everyone's buying based off that criteria. So it might take a month to 3 months for buyers to kind of, or excuse me, sellers to kind of realize that that's the case. But in 2022, I can think of one house in particular. We put an offer in on for, I don't know, like $20,000-$30,000 less than what this person was asking. And they're like, hey, I got it. I'm going to wait 2 weeks and see if I get a better offer, and I'll let you know. We're like, all right, fine. It expires in 2 weeks. And they called us back like 7-8 days later. They're like, all right, yeah, we'll take your offer, And so no one else is going to offer any better. So you just adjust accordingly to what you need to do and how you need to buy. And everyone else is going to follow suit, because it's not like some guys over here found some mythical bank that's giving them 85%. I mean, they're following suit with the market. So it's just a matter of getting those sellers to understand that, hey, you're and being able to come up with some creative terms. Hey, I'm gonna I'll give you what you're asking for it. Let me come in and renovate it. We'll pull up a contract, and I'll pay you when I get paid. Do some things like that. Get creative with the financing terms and coming up with strategies to make it work. Find ways to make up for that 10-15% cut in LTV. Nick, I think you had something, brother.
Yeah, no, I think Forrest kind of alluded to it, man. I thought you said something that was profound early in the episode, when you were just saying you had to have the mentality to succeed no matter what the market conditions are doing. So I wanted you to kind of drill down on that, and I wanted to kind of, from your perspective, what was so unique about KC Capital? A lot of people struggled in last year in 2022 with the spike in the interest rates. So can you kind of speak to your, like, what was your due diligence process like? How were you making those adjustments to where, you were still able to thrive in 2022? So can you speak to, like, what was your mindset? Why was it different? And what things do you attribute to y'all's success last year when a lot of people, were struggling?
Yeah. So, the biggest thing is this whole journey into real estate has kind of been, it's been difficult. I mean, there's no other way to put it, right? And when you think about when we really started doing investment properties and started doing our properties on our own that weren't for other people, I mean, we started doing those in 2018. So if you can draw a timeline of real estate and events between 2018 and today, it's horrific. I mean, it is a horrific set of circumstances to to deal with real estate and try and create a successful real estate business. I mean, it's like every time you turn around, it's just something else. when do you think we started really recovering from 2008 for us, like seeing a semi-normal market? What year?
Was it
14, 15, 16? Like really stable, normal
I'm talking. I
prices coming
mean,
back right.
yeah, you know, 14, maybe
Yeah,
13, 14. I mean,
yeah. And
my
then really
business started getting
driving
busy
back
again
up.
in
Yeah,
2010, 2011. But as far as the
right.
real estate prices and stuff, yeah, I'd say
Yeah.
14.
So 14 they started going back kind of in the right direction, and then we really didn't start seeing a good like year over year appreciation, till it started getting a little bit later into there 15, 16 and on through there. So like we come in and start doing our first investment properties, in 2018, and the market's still kind of a buyer's market. It's not a seller's market, or there was very brief spaces of sellers market, and then things are going good. We make these deals, and then COVID hits, and it's like, what in the world? COVID was just, I mean, it was irrational, right? Like there was nothing logical or rational about anything that occurred during that time. And so then that hits, and all the issues that got brought with it. I mean, supply chain issues. I mean, that was massive, right? Like the cost of a sheet of OSB plywood went from $8 to $65 a sheet. Which kudos to the people that make OSB plywood, because then they reduced it down to $15 or $16 a sheet, and everybody's happy about it. And I'm like, y'all realize y'all are still paying 100% more than you were in 2019, like, or 2018 or whenever it was. So I mean, a cost increase of like 800% in building materials. The market's completely changing with lending, and what flies and what doesn't. Like I said earlier, people just completely shutting their doors, and then you fast forward to just the craziest uptick in appreciation. And let me ask you this real quick for us while I'm still answering this question. But when was the last time that we saw such a rapid increase in home values like we did in 2021?
Not one in my 25-year career,
Yeah.
but I'll
Okay.
say
So
this.
yeah.
I thought I just want to comment one thing is I had people talking to me in 2020 and I was giving horrible advice. I said, because when we were in lockdown and all this, I said, people are bound. Think of, I left the company Home Express I was at to come over to the broker side because they stopped funding loans. And I was like, I
Mm-hmm.
can't survive
Yep.
on a base. I need to make commission. I need to fund loans. I can't survive. Well, how many other people were in a similar situation? And I just thought there's going to be people who are, well, I mean, just look at restaurant workers, at least tons laid off. I guess they were stimulated with all, with the crazy unemployment stipends and all this stuff. But I was thinking there was going to be blood in the streets, and I was thinking we were going to see massive foreclosures, and I was thinking the real estate market was going to crash because of COVID. That's what I thought in the first 6 months of COVID.
I think a lot of people
And
thought that.
I was telling people, don't buy, wait, discounts are coming. And then I look like
Mm-hmm.
a fool a year later when it's just keeps going. And
But completely unprecedented though.
yeah,
Not.
unbelievable,
Yeah.
unbelievable.
Yeah. No. I mean, yeah. I mean, there's nothing about that I don't think. I don't know if anybody was like, "Hey, home prices are going to rise by 30% in a single year." Next year. No one thought that during COVID. Like that came out of nowhere. I mean, it was wild. Like just, I don't know. I mean, do at this point do we even have a real explanation for it? No.
I don't. I don't have any idea really. I mean, sure, low rates prompted it because it just
Yeah.
increased buying power by
Yeah.
so much. Now
Mm-hmm.
people could really throw money that they otherwise wouldn't have had at properties. With so
Nick, hold me
that's the one.
accountable to your question you asked me. I'm gonna come back to it in just a second. Hold me accountable for it. So hold on here. So let's talk about that. So we're talking about how this is the time for investors, right? And they're like regular home buyers are getting shoved out the market, and obviously we're real estate investors. So I mean, we enjoy being able to buy properties. We don't want to do that at the expense of other people, though. But okay, let's back up here. So rates were at an all-time low, and do you think that was a byproduct of COVID? Like, do you think that was trying to stimulate the economy?
That was, yes. COVID was when the Fed started that bond buying program. And that was really what brought the rates down, was Feds now. And I'll be honest, I have a hard time getting my head wrapped around exactly how the dynamics work. But I'll say this, the Feds historically, they don't buy mortgage-backed securities. They did that as a means to stimulate the economy. I should know, but I don't know exactly how them buying those improves. Well, that improves obviously the sellability, and maybe that may be the only real reason that investors, can offer the lower rates, which that's the part I admittedly don't really understand, but it's a direct result because prior to that, Feds weren't buying mortgage-backed securities. Then they started, and it was pretty consistent. That number is right around 80 million a month, which is just a ton.
Yeah.
And so again, how it correlates, I can't really paint the perfect picture, but that is what dropped the rates. And then when they say, hey, we're tapping out, we're done with this, that's when they shot right back up.
So it's a slingshot effect. It's a slingshot effect, right? Like the same, just like they pumped. And forgive me, I forget the statistic, but like they printed the most money. What year in 2020 or 2020, right? They printed more.
Sure,
like
it
was some wild figure, like 70% of all money in circulation in that year was printed like in the last 6 months.
Yes,
you're like,
I
what?
remember that.
If that's not overstimulation of the economy, I don't know what is. So there's that, right? Like that's what everybody understands and knows about. But then you have them buying these bonds to reduce interest rates to stimulate the economy. And as a result of that overstimulation, housing prices skyrocketed because people could buy more. And now, because we're buying too much, we're buying more, inflation's too high, we're going to raise these interest rates and make it impossible for these same buyers that we were trying to help to buy these houses. And now it's pretty much just open to institutional investors and investors in general.
Well,
that's crazy.
I'm a little cynical on all this stuff. I don't think they were legitimately trying to help anyone buy homes.
Oh, absolutely. I mean,
that was just that was just a byproduct of what they did.
Yeah. No, like I think we're at the end game plan here. Like everything has a bigger picture to it, and that's just kind of when you start putting them pieces of the puzzle together, you're like, wow, where we are right now is due to complete overstimulation. I mean, you know what? We should have just left rates at 4% and 5% and kept everybody happy. And but I guess if that was the case, then the general economy wouldn't profit from the government's ignorant decisions. I mean, I guess that's how it goes. They make bad decisions and people find ways to profit from them. I mean, that's the only thing. I mean, might as well make the best of a bad situation.
Yeah.
So that's all we can do. But so Nick, going back to your question, so it's been a absolute roller coaster in real estate in general. It's been completely wild. We've talked about the things that have happened that have affected that. So really this whole time that we've been trying to build and create this business in real estate and be successful at it, it's been like any challenge, any obstacle that could possibly occur has occurred. I mean, from a global pandemic that's unprecedented, from a rise in housing rates that's or values that is absolutely unprecedented, to a rise in interest rates that's historically, rapidly, how rapid they rose is unprecedented. I mean, we've seen some historical events. And the problem is that no one knows how to react to those events. Banks don't know how to react to them. Supply chains don't know how to react to them. People in general don't know how to react to them. The market doesn't know how to react to them. So, it, basically, the mentality that was born was out of necessity. It was because there was no other option. It was either don't do it or figure out a way to do it. I mean, there's no choice. You can't. It's either sit down and shut up or figure it out. And anybody that was institutional before then, they're sitting on billions of dollars and they can weather it out and they don't care. They'll stop buying, they'll stop doing whatever, and whenever everything clears back up, they'll come back and do their thing. But having started in an absolute Six Flags of a time frame, there was no choice. There was no choice but to figure it out. There was no choice but to find alternative ways. There was no choice but to learn different methods, different strategies in creative finance. And through successes and through failures, fortunately, because we did so much stuff for other investors and through other institutional investors prior to us really just hitting this thing hot and heavy and hard, we saw a lot of their mistakes. So we kind of learned what not to do on their dime. That's not to say, that we don't make mistakes here and there. I mean, everyone does, but they're minor. They're like, oh man, we made, 40% return on that instead of 175. We made $10,000 instead of 20. But we're still. I mean, we underwrite so conservatively that like even if something goes wrong, we're still good and we're still making money. And I guess that's done because it's been out of necessity. We've seen the things that have gone wrong, and we're like, hey, we need to know how to prepare for that. We need to know how to off this thing if everything goes south. So that's the mentality. I guess it's survival instinct. When you're thrown into the middle of the wolves, you got to figure out how to keep it going and how to fight. And because of that, we do just fine in markets that are absolute garbage. And it's not that they're garbage; they're changing so fast and so rapidly. I mean, like Forrest said in a conversation right before this, hey, I got to go back and call all these people because things changed since last week. Things changed since 2 weeks ago. Like nothing's staying the same. So if you have, and we spoke about this the other day, Nick and Jason, if you have just single family in mind, if you have just multifamily in mind, if you have just creative finance, just traditional finance, just this, just that, if you put yourself in a box in these markets and in the volatility that exists within real estate today, if you put yourself in a box and say, I'm only going to do this, I'm only going to do that, I'm only going to do this strategy, this type of property, that is guaranteed to be the downfall of your success and your company, because there's just absolutely no way that you can put yourself in a box like that in the times that we're in right now and have been in for a while. So that's definitely the biggest thing, is the ability to adapt, overcome, and say, failure is not really an option. How can I make this work? So, but yeah, man, we've talked about a lot of good stuff. I've thoroughly enjoyed this conversation. Nick, Jason, man, y'all got anything y'all want to add? Any questions for Forrest?
I was gonna say, I just thought it was very insightful for when he kind of started hitting on like the non QM, and you typically think about traditional ways of qualifying for mortgages, and especially as I've been an entrepreneur for over a decade. And to Chance's point, you're always trying to write off as much as possible, and so you write off, and then your income doesn't look that great, but then you need lines of credit and different things like that, and you need to qualify for a home. And so, sharing that, I think that's just a massive value proposition for people who are in the entrepreneurial space.
Thank you. Yeah.
Yeah.
A lot of that stuff doesn't get talked about unless I have a client that is in need of it. So I appreciate that. You saying that. I do a lot of videos, like, informational videos on social media. I'm going to make myself a note and make a video just real quick, just kind of going over some of those and just saying, hey, if you're self-employed, you got options. And appreciate that, because I guess, I don't think about it because I eat, sleep, breathe this. But there's a lot of
Yep.
people who probably don't know those options are there, and they kind of, like we talked about, maybe for this person who doesn't think they could ever buy a home because of credit score or whatever, or down payment. We talked about the FHA. Same for self-employed bars. My brother is a contractor also, and he is, well, I always tell him differently, but he was of that belief. He say, I write off everything. I don't show any income. I can never buy a home. I said, that's not true. It's just, that's so yeah, that I thank you for mentioning that, because yeah, I'm going to put that out there. A lot of people will probably appreciate knowing that as well.
I didn't think about it till you were talking about the FHA, and how just all the different programs, and that's how you and I connected originally. And when I was thinking about that, I was like, wow, there is a lot out there, but that's almost everybody's. That's always their focus, right? Like, it's always like, yeah, you can get it with low credit. Yeah, you can get it with low down payment. And that's always like someone's focus, because that's always considered the biggest obstacles. So when you were talking about that, I was like, it was that was one of them things that was like difficult. Our start. That's one of the things of how we started. Is we went and that's how we got the capital we needed to do what we're doing, to do how we started in real estate. Is we went in and we bought this house and we renovated it, and we got the money out of it after we increased the value, and that's what we took and started using to do our own deals and to really get our investment experience off the ground. And so when I thought about that, I was like, man, no one told us that. That was the same thing. Like, we were like, hey, how can we qualify for this? And failure wasn't an option. And I can't tell you how many people I talked to. I mean, my God, that was like, I remember man. This is a divine moment here. Do y'all remember the webinar, right? The webinar that we did, and we had a property on there. It was 1115 Mary Drive. It was the one that I talked about how we were doing the construction for an investor and all this stuff and yada yada yada, and he ended up running out of money because he had the wrong contractor in the beginning, not us, and he had the wrong realtor and all these different things. And then we came back in 6 years later, and he was still in foreclosure. He'd been paying interest only payments this whole time trying to sell this thing. And he we bought it from him, and we bought it back from him. But I remember that is the house that I was at whenever I talked to Forrest for the first time. So I was actually at that house in the backyard talking to Forrest, and I was like, so yeah, it's just kind of crazy how that like all came around full circle, but yeah, so that I mean, the amount of people I had to deal with and talk to find that information is not readily available. There's nothing that's just like, hey, this is what you can do. It took so much research, so many phone calls. I mean, countless nights staying up researching, different strategies and what you can do. And but yeah, I remember being in the back of that house and talking to you, and I was like, yeah, well, I think we got it figured out. So it was just kind of funny how that came back full circle.
That's awesome.
Yeah, that's pretty crazy. So, but yeah, Yeah, man, it's been a great conversation, great talk. I'm hoping that people get a lot of value out of this. And definitely appreciate you having you on, and absolutely, like we talked about earlier, we'll get together and we'll talk about some of that financial literacy stuff, and
Yeah.
I think there's going to be a lot of value to both within everybody here, their businesses, and to the people in general. So definitely
You,
looking forward to that.
you bring up a good point. I kind of feel like it might be good to even put together, I could just put together a PDF of kind of some of the stuff we talked about, more for those first-time home buyers, showing them, hey, really, and really for the home buyer that thinks buying a home is hopeless,
Yeah.
to show them, hey, you don't need perfect credit. You really don't need any money down right now.
Hmm.
As long as the property will accept FHA, and you can get into a place with no down payment, have the seller pay the closing cost, and you're not going to have a payment due for a month, and then odds are a lot of places you're going to be able to, particularly with the way the rent has skyrocketed, you're going to, granted the rates have as well, but you can get into a place, and if you can just stomach the payment for a little while, whether it's 6 months or 12 months or 24 months, who knows at this point, but rates are going to come down, and you can do then a streamline refinance. And I want to touch on this real quick. If you guys aren't familiar, an FHA streamline refinance, you don't need credit, income, or appraisal. So
Yep.
it goes off your original qualification. So that's why you don't need to have the home reappraised. Credit score doesn't matter. Income doesn't matter. Your income could have gone to hell, whatever. But it's as long as you can do FHA streamline refinance as long as you can lower the rate every 6 months, every 6 payments.
Wow.
And so you could just write it down. Like, say we're up at the top right now. Let's say rates start coming down in 6 months, and then every 6 months it's lower. The other thing is you're not allowed to add any cost to the loan. So what we do is we take a slightly higher rate that builds in a lender credit that covers all of the closing costs. So you're not adding to your loan balance. You don't need to credit or income qualify. You don't need to have the home appraised. So it's great. Like I said, part of the reason I'm using this strategy to buy a home is because I'm going to buy a home. And I think I mentioned this to you the other day, unless I'm mistaken. I have a choice. I either
Oh, you got to
Okay.
call somebody to figure. Hey, look, you got to submit a lead form to Casey Capital to figure out what we're laughing at. All right, so so call one of our account executives to figure out what we're laughing at. So anyways, so I think this is a perfect way to kind of close this out. So out of everything we've talked about the market, we've talked about where it's at, and various opinions of whether it's a good time to buy or not for home buyers or for investors. This is kind of a rule that I've heard in real estate, is that now is always the right time to buy, because at the end of the day, no matter what the market does, no matter anything, home values will always trend upwards. So if you're thinking, hey, if I buy right now, I'm paying this higher interest rate. Well, if you wait 3 years from now, what you would have saved in interest probably is going to be made up for by the extensive home value that was added. Right. And so with a program like this, like you're talking about, it even mitigates the risk of that. I mean, you only got to stomach your rate for 6 months, and if it goes up, leave it alone. If it goes down, take it back down. So, I mean, now today is always the time to buy. There's going to be so many people imagine the people during COVID, they're like, hey, now's not the time to buy. We don't need to, like you said, you know what I mean? Don't buy, don't buy, don't buy. And it's through no fault of your own. There was absolutely no way it could have been predicted, right? But it just reiterates the point that now is the time to take action. Now is the time to do something. If you don't do it now, first off, who knows if you got tomorrow, right? I mean, absolutely nobody knows that. But on a less morbid scale, I mean, you know that the home values are going to go up. So now is always the best time to buy a home, really, regardless of what the interest rate is, because you can always get out of that, through a refi or whatever.
There was a couple components you left out, and yes, ultimately, even with some dips in the long run, home values will go up. So it's funny, and that's why I always say that I'm a big advocate of putting the absolute minimum down. And
Yeah,
why
leverage.
put 20% down when you could put 5% down on conventional, use some money for renovation, or use that 15% and go do a DSCR loan and go buy an investment property concurrent. You could do that. So the money,
Or you can put the money in KC Capital.
Yeah. So
yeah,
put the minimum down, but for the person, I always tell this, for the person that's saving for their down payment. Well, by the time you save that 20%, guess what? Now instead of buying that property for 500, it might be 560. So you're on a hamster wheel and you can't catch up. So there's that. And then we didn't talk about, with the values going up, so is rent, and that's never coming down. So you're waiting, you're saving, you're paying more rent, and you're on this hamster wheel of rent, hamster wheel of paying more rent and saving more money just to see your dream just run away from you.
You're running on a treadmill. You're running on a treadmill. I mean, you're running on a treadmill trying to get to the end of the road, and it just doesn't happen.
Not to mention the tax benefit. You get right off your mortgage interest. On the home I'm buying, I'm looking at what is effectively, I'm looking at it as I'm going to have about a $15,000 write-off from buying this home for just the mortgage interest. And so I'm looking at that as like, that's, if my mortgage payment's going to be $5,000, well, when I factor my tax savings, I'm really at like $4,000 a month. It's, you have to look at all those things, and it starts really, you kind of have, if you can walk someone through that, you have an aha moment, like, I got to buy right now. There is, I'm only hurting myself by waiting.
Yeah. Yep. Absolutely. I mean, that's across the board. I mean, now is the time. I mean, you hear all kinds of people. I mean, the time to take action is now. If you don't do it now, when are you going to do it? And if you're waiting for something, whenever that time comes that you were waiting on, you're going to find another reason. Like you said, the value of my house went up $60,000, so now I need another, $12,000 to put down. Well, I don't have that. Let me wait again. No, now I need another $8,000. I don't have that. So that's some very, very good stuff. So I mean, the end result. What's the deal with 2022? It was crazy, but now still the time to buy. Now still the time to do it. And whatever day you decide to do it in 22, that was the time to do it. Tomorrow's not the day. Yesterday is. I mean, it's only gonna go up. So I mean,
if you can stomach the payments now and not create a financial hardship for yourself, think of how nice it is when your payments start dropping, and then you're going to be in that same home you love, but now I'm paying, $400, $500 less a month. And how good are you going to feel then?
Yep. Absolutely. Well, Forrest, Jason, Nick, y'all got anything?
No, man, we'll be over here talking for hours, man. I'm looking forward to drilling down. I want to talk to Forrest some more, because really what he does is a gateway to wealth creation. You know what I mean? Because that's what we teach, is to buy smart. You use that FHA loan, also the 203K loan, to force the appreciation, and find a house with some equity in it. And then when you're able to pull against that, you can use that to passively invest in something like KC Capital, or fund a whole life insurance policy. So a lot of people think that to have that type of money, it's impossible because they live in check to check. But if you just get into a home and you get a home with some equity, then you can really set yourself up for wealth creation. So I really want to drill down on that later. But I just want to thank Forrest for what he does, and it's just a valuable, service that you do to the community, man. So I just wanted to say that.
Sure.
Thank you, Nick. Thank you, Jason. I want to add one more thing, because you just touched on something that is important. hey, for that person that wants to use that strategy, FHA loan with the grant, no money out of pocket, seller pays their closing cost. That person could still say, hey, well, two things on that. One is if they still have a problem qualifying because of income, okay, you can have what's called a non-occupant co-borrower. So you can have a family member, who, trusts you, come on,
What?
and they don't have to live in the property. And yeah, it'll be reported on their credit. So, it's going to obviously be someone pretty close to you that, cares for you. But then that person that, if you I'm talking, if you're trying to get at a home that you really can't afford yourself, if you can get a non-occupant co-borrower to help with qualifying, well, you get a 3-bedroom home, rent 2 rooms to your buddies. And now you're house hacking, and now you now live in that home for 1 year. You go do the same thing the next year, get a new home, and rent that home entirely, and now you got your first investment property. No money out of your pocket. There's a million ways to do it. It's hard for someone to find an excuse.
Yeah. Yeah, absolutely. Absolutely. And that's it. I think being able to get these resources out to people is really going to be game changing. Like I said in the very beginning earlier, talking about how we wanted to be able to provide financial literacy out to the tenants. Not everybody's going to take a hold of that and do something with it, right? But there's people that will. And the same thing with this information. There's people that will grab this and be like, wow, this is exactly what I've been looking for. This is exactly what I needed. And so yeah, that's definitely awesome that we're able to do some things there, maybe change some lives.
There was someone I told that same analogy I just mentioned to Nick about, and they said, well, I don't want roommates. I said, well, you're renting and you have roommates now. So
Yeah.
you're renting and you have roommates now, but you don't own the home. So
Yeah.
you want to stay the course, or do you want to own the home and do what you're doing? So
yeah,
some people you
it's
need
got
to
to take
shake them up a
some
little bit.
sacrifice somewhere. My goodness, there's got to be some sacrifice somewhere.
Yeah, right.
Yeah, nah, it's
Yeah.
crazy. Yeah, like, all right, dude, I can't help you, man. I don't know.
Yeah.
Like
Done all
once
I
you
can.
get to that option, like you've explored so many other things, right? Like this is like the Hail Mary, and he's like, oh, I don't want to play football,
Yeah.
Like, what? Okay, whatever. So, but yeah, man. So it's been great for us, guys. It's been great. We'll be on the next one, and we're gonna come up with a new what's the deal topic, and we'll hit it off and get it out there. So thank you guys so much for being on here. Appreciate y'all and y'all's time, and we'll catch y'all on the next one.